Obviously, you've seen a lot of cycles and a lot of ups and downs. Where are we in this one?
Emily, great to be back. Yeah, I think we're probably somewhere midstream between the downturn and somewhat of a correction in valuations, and hopefully sometime next year things will come back, but we're right in the middle of it, I would say.
What does a hawkish Fed mean for VC?
It's tricky, right? Most of the companies that we fund lose money for a long period of time and then make money somewhere towards the end of the life. And when you have money making or positive earnings at the end of the life and high interest rates, you discount that back to today and the value drops a lot. And that's really what's causing the downturn in all of the larger tech companies and even the private ones. So I think a hawkish Fed means that we're going to be sitting in this stuff for a little while until they get inflation under control.
We've had guests on the show who say there are going to be millions of layoffs in tech, that this downturn is going to last 2 to 3 years, that this isn't going to be just a blip. How does that square with what you're projecting?
I'm not convinced by that. I think when you actually look at the U.S. economy in general, it's in a pretty healthy state. I think there are something like 2 job openings for every unemployed person in the U.S. What we look at B2B businesses in our portfolio, I wouldn't say that they're destroying their goals or records, but they're doing reasonably well. So overall, the economy is not in that bad a shape. Banks are in a good condition, good balance sheets, and so forth. So we definitely got a little out of whack in terms of valuations and where the market was, and the consumer is definitely being a little careful with their wallet. But overall, I think that we're in a decent spot, and I think the recovery is around the corner somewhere.
Now, going into this, VCs raised a record amount of money. There's a lot of money in those war chests. Has it been hard to find places to put the dry powder?
I'd say it was a very slow summer. I got a lot of text messages from my VC friends while vacationing in Italy. but
not calling anyone out specifically, but okay.
It's been a slow summer. I would say that we're seeing some green shoots. One of the things that happened over the last couple of years, there's a lot of companies that have been seeded, and those companies are coming up for Series A investments. We're seeing some growth companies get term sheets. Maybe they're not straight equity and they have some preferred structure or some general structure on these term sheets, but we're seeing it come out. And I think, generally speaking, you're right, venture capitalists that have capital to deploy aren't going to twiddle their thumbs for the next 2 years. So I think you're going to see some movement.
Does that mean that, what happens for VCs then as the cycle progresses? Will VCs not raise as much money over the next couple of years as they have over the last couple of years?
Yeah, I think that's the case. I think that the LPs that have invested in our funds have been drained pretty hard over the last couple of years. Because the IPO market is closed and there hasn't been a lot of M&A, they're not getting money back. And so they're going to be reticent to give us more funds. And I think we're going to generally slow the pace down until we start to see the exit market open up again, be able to pump some money back to the LPs so they can come back our way.
Now, it's interesting, we actually talked to the CEO of Pilot, which is a company that Index has invested in. Yep. They provide CFO services to startups, and they've done some surveys of their companies and found it doesn't necessarily look as dire as it sounds. Take a listen to what he had to say.
2 things are happening. The first is that there's definitely pain from the downturn, but I think it's more specifically and more pronouncedly felt by companies that really have nice-to-have offerings as opposed to really need-to-have offerings. And the second is, I think the dynamics in kind of the late stage and public markets are very different than what you see in the earlier kind of mid-stage ecosystem for startups.
What do you make of that?
Yeah, I think that's pretty accurate. Late stage startups over the last couple of years have raised a lot of money, and most of the particularly good companies have quite a strong balance sheet. So they don't need the capital. They're going to wait for the markets to come back. They're going to pace themselves and so forth. I think the earlier stage companies, look, they just don't have as much money in their war chest. They're going to have to come back to market. So I think we're going to see opportunities in the earlier stages. And overall, I think that there have been certain sectors in our industry where there's been heavy hype, which a ton of capital has gone into, and a ton of capital will run away from those. Whereas more kind of the steady, well-known sectors, I think will continue to perform as expected.
What do you make of Andreessen Horowitz writing its biggest check ever to Adam Neumann?
Look, Mark and Ben have been contrarian many times in the past. They're contrarian this time. I'd say, the average polling in the industry would indicate that this wasn't the best idea ever. But, we'll wait and see. The guy is a special guy in every sense of the word. And, it's something that they wanted to do. We'll see.
So you have Mark Andreessen doing that on one hand. You've got Benchmark staying strong on the other. Where is Index? What is your strategy in a downturn?
Yeah, look, I think it's interesting. What I find interesting about this industry is that if you went back and listened to what people were saying 6-9 months ago, there was this sense of like, oh, the industry is completely changing. You're going to go to these hedge funds that deploy capital at high velocity. They're going to use the tech market like some kind of an index market, no pun intended, and that all these smaller, more niche firms will go away. And it's turned out to not be the case. I think that the founders and entrepreneurs that take our capital are very diverse. They look for different things from their investors. Some look for folks like Benchmark, some looks for folks like Andreessen. Our view, we kind of think of it as curated growth. So Index, the last fund we raised in totality was a little over $3 billion. In today's market, that's reasonably large, but definitely not the largest. I think that gives us enough dry powder, enough capabilities as a firm to offer the services that our founders want, but we're not so small that we have to be niche-y. So somewhere in the middle of the road is our view.
If there is a bubble in the market, private markets, where is that bubble? Is it crypto? Is it quote unquote Web3?
I don't know that there's necessarily a bubble right now, honestly, Emily. I think that things have generally well corrected. There was a bubble in crypto, for sure. I think it's long gone. Yesterday, I think it was reported that NFTs on OpenSea were down 99% in 3 or 4 months. So clearly, the air has come out of that one. And I think companies are trading at somewhere near realistic values right now in the public markets. What I would say is a lot of the growth companies that are growth stage right now are still holding on to the valuations that they got from the tail end of 2021. And those are probably still inflated, but they're not going to raise their next round until they can catch back up to those numbers. So, we're not going to see the air come out of that balloon for a little while.
And what's your advice on those companies that were planning to go public this year?
Yeah, so you have two varieties, right? You have the ones that don't need capital, in which case you just stay hunkered down, grow your business, and wait for the market to come back. At some point it will. And you have the ones that need capital. And if they need capital, they're going to have to raise it. And right now what the market is coming back with is debt, it's structured equity, it's convertible notes, and so forth. It's hard to come by a term sheet that is clean equity. You got to figure out what the best option is, select that one and go for it. But if you need the capital, you got to raise it, and it's out there. It's not that it's impossible to raise money right now.